Greetings from MWN.com. Dr.M.Wilson, formerly Vice Principal and Head of Department of Commerce, Scott Christian College, Nagercoil is delighted in presenting this session. Thank you. Please subscribe the channel MWN.com. National Income Determination. National income determination refers to the study of the intersection between the aggregate demand and aggregate supply. General price level and national income are obtained through the intersection of aggregate demand and aggregate supply. National income is also measured in terms of real gross domestic product (GDP). National income is the total value of all goods and services produced by a country's residents within a year. It is calculated by adding up the incomes of individuals, businesses, and the government from various economic activities. It is the total value of all goods and services produced in a country during a given year. It is an important economic variable that's used to measure economic growth and the state of economic well-being. Components of national income. 1. Gross national income, GNI. GNI is concerned with the total income earned by citizens and residents and includes money received from sources outside a country. 2. Gross domestic product, GDP. GDP is concerned with the value of all goods and services produced within a country and specific period of time. GDP is normally calculated for 1 year. 3. Net indirect taxes, NIT. Net indirect tax is the difference between indirect taxes and subsidies. Net indirect tax equals indirect tax minus subsidy. Indirect taxes mean taxes paid by producers on the production, sale, purchase, or use of goods and services. Subsidies mean grants made by the government to private enterprises and unincorporated public enterprises. Subsidies can be used to ensure a guaranteed price or to keep prices below production costs. Ways to measure national income. 1. Sum of expenditures. The total amount spent by households, enterprises, and the government. 2. Sum of value added. The sum of value added at each level of production. The total value added is made up of the value added for agriculture, industry, and services. It is one of the methods used to calculate GDP, along with the expenditure and income. The sum of value added is equal to the sum of factor incomes, which include rent, wages, interest, and profit. 3. Sum of income earnings. The total amount of income earned from economic activity. The sum of income earnings can refer to gross income, net income, or national income. 4. Gross income. The total amount of money earned before any deductions or taxes. This includes wages, salaries, profits, interest payments, rents, and other forms of earnings. 5. Net income. The amount of money earned after accounting for all expenses and deductions. For individuals, this is typically called take-home pay. For businesses, it's commonly known as profits or bottom line. Determinants of national income. The important determinants of national income are as follows. 1. Aggregate demand. The sum of consumption and investment expenditure on goods. 2. Government expenditure and tax. The government's economic activities can affect aggregate demand through fiscal variables like tax and government expenditure. 3. Factors of production. The quantity and quality of land, labor, capital, and organization. 4. Number of entrepreneurs. The total number of entrepreneurs of micro, small, medium and large enterprises in a country.